So you want to know how to track transactions and assign them a certain element, item, direction in the accounting equation, right? So you want to know like whether a transaction is an asset, liability, revenue, expense, where it comes from, etc. And this is very common the way you get tested in accounting class. So to begin, we're given the Speedy Delivery service, which is operated by Chris Myers, and these are all of his transactions. And so we start with the amount of cash that he's received, which was an investment from the owner. So the business received an investment from the owner, $30,000. So the business received an asset in cash, which increased because it received $30,000. And so the amount of capital that the owner has also increased because he had invested into his business. So over here, we have a new scenario, right? The business has paid advertising expenses worth $3,500. So right off the bat, it even says it in here, it's an expense. So we can assume that the first element is going to be an expense. But what kind of item is it? Well, this would be an advertising expense. Because as you see over here, it says paid advertising expense. So then what happens to the direction when you input an expense, advertising expense? What happens? Well, the direction is that it increases. Basically, the amount of expenses that you've had to pay on advertising has increased by $3,500. And so in return, what element did you have to use to pay that expense? Well, you had to use your assets, right? In order to pay for your advertising expense of $3,500, you had to get $3,500 from somewhere. So you got it from your assets, your business assets. And what happens when you get money from your assets? Well, you have to use cash, right? You're paying $3,500, you have to pay in cash. So you're taking your cash assets and it's going to decrease, right? So think of it like this. This is the business. It has this much money and it needs to pay off this expense. Well, in order to pay off the expense, it has to take the money and move it here, right? So now it's going to look something like, before it looked something like this. Now it looks something like this. You know, the advertisers didn't have any money, and now you don't have any money because you just paid off the advertisers. So that's kind of the illustration we're going with here. So when we're purchasing supplies on an account, right, in the next question, the first element that we're dealing with are assets, because supplies are assets to your business. The reason why supplies are assets is because supplies is what you use in the production process and in running your business. So obviously it's an asset that you own, right? You're purchasing supplies. Like if you're like a car business or maybe your delivery business, you purchase like a car, that's now your asset. You use the car to make revenue by like doing whatever service you offer with it or however you use the car. And so the item in which we're going to be discussing here is supply. But what happens when you purchase supplies on an account? Well, your assets of supplies increases. And the reason why it increases is because you just purchased supplies. You added more supplies to your assets. So then what happens after this? You know, because you have spent $2,500. Well, you have a liability. You have to pay that $2,500 for the assets that you just received in the supplies. And so this would go under accounts payable. And this would be an increase in your accounts payable because now you have money that's owed, right? The amount or the money that you have paid, right? So originally we had no assets, right? No supplies. Okay, and then we decided to purchase supplies, right? So there's money here in supplies, and we purchased it. So the supplies are gone, but the supplies it doesn't really matter that the supplies are gone because now we have to pay this money back to where we got it from. And so that's a liability. And that serves under accounts payable. Right? So that'd be an increase in both. So if you try this question, you can use these same principles. If you bill a customer for delivery services on your account, the first thing that's going to happen is that since you're billing customers for money, it's going to be categorized as an asset that you earn, right? And so the item in which it will be found under is going to be accounts receivable, because you're earning assets in your accounts receivable. But when you bill customers, you also, of course, increase in the amount of assets, because yes, you're gonna earn $18,000. And so what happens when you increase in assets? Well, you get revenue, right? And when you get revenue, what item would that fall under? The delivery service fee, because we're billing customers for delivery service. So we're going to be earning revenue via the fees that the customers pay. And so the amount of fees that the customers have to pay will increase because we're charging $18,000. Okay. And number 5, received cash from customers on account, $14,150. So when you receive cash from customers on account, this would be an asset, and you'd receive it in cash. And this would thereby increase the amount of cash that you have. But on the other side, when you receive cash from your customers, then the amount of money that you're in the accounts receivable, right, asset accounts receivable, decreases. Because basically what's going on here is that originally in your accounts receivable, you were to get paid. And now that you did get paid, there's no more like money that you have to account for in the account receivable. It's gone into assets, so it decreases. And if you do these, you will be getting the right answer.